Hey everybody, this is Lance from thetatraderz.com. This video I'm going to go over an update on the covered strangle strategy. Just closed out a really good return on a trade. Haven't had any losing trades since we've started this service in over 2 years. Members of Consistent Passive Profits or the Safeguard strategy get access to this with lifetime access. So I'm going to go over the trade that we just did. It did take a couple months, but made almost 30% on our money in the trade. So let's get right to it. All right, so this is a covered strangle with futures. I actually started this trade all the way on February 10th, 2025. This is a strategy that sometimes works out right away. Other times you might have to be patient and collect premium. Selling a covered strangle is when you buy a contract of futures or 100 shares of stock, and then you sell a covered call and sell a cash secured or naked put with it. So MES was at 60.80 on 210.25. 49 days out, I sold a 57.50. Remember that number, it'll be important later. And sold the 56.50 put. I took in 52.35 premium. The deltas were 0.15 and 0.1. This was 0.15. This was 0.1 delta. And then had a few questions on how to manage it. On the strategy guide that you'll get access to if you join, you'll see all about it. And right here in March 2025, I closed out the 56.50, the one that was a little bit further out of the money. I closed out at 5.75. I left the 57.50 on. At one point, you could have closed the 57.50 to have a net profit, but I stayed in it. And I wrote going to be a close one. Then if under 57.50, then we're going to get a sign on the contract. And then at that point, you'd sell a covered call and also sell a put to turn it into a covered strangle. I usually started off by selling 2 naked puts just to have a little bit more cushion on the downside, being okay getting a sign at a lower price. If it was above 57.50, then we would just reset the strategy, sell 2 puts. Then I said likely to get assigned. Hopefully you close the 56.50, which most of our members did. And then going to get assigned at 57.50. I said before the assignment where we're looking to sell covered calls at. Notice that the premiums at the time, 25 days out, was giving quite a bit, between around 30 to 65 premium or so. With MES is a 5 multiplier, so multiply all those numbers by 5, and let's say the dollar amount that you would be taking in premium. I also said where to sell a put, so I'm pretty active in looking at possible strike prices of where to sell them. And then I said probably sell around the same 57.50 when we got assigned. It gives 60 premium times 5 is $300. And this trade needs about $3,000. So that was 10% if you took it. Later on in April 4th, I sold a 24-day put at 52.70, quite a bit further from the 57.50. And then I sold a 24 DTE call at 5,800. This was higher than the 57.50 where I got assigned. So if it gets to 5,800 or above, we would not only keep the premiums that we received, we would also get some capital gains because we got assigned on the 57.50, and then we would be agreeing to sell the contract at 5,800. That would be a 50 premium difference or an extra $250 on the trade. More about that. I'm going to let both expire worthless, then re-enter. They both did expire worthless. I was able to keep the premiums, 28 and 37. It's about 65 or so, times 5, over $250. And then I sold another one because they both expired. Say where I'm going to sell the strikes. And then at that point, I sold the 5,800 call again, 50 points above the 57.50. I got 13.25 on the premium on that, and then sold the 4,900 for 13. So I'm constantly looking to sell premium via covered calls and cash secured or naked puts, lowering your cost basis, being patient on the market for it to go up. And then on 511, a week ago, if we close above 5,800, we'll be out of the covered strangle completely because we would lose the contract that we were assigned on, and then also the naked put would expire worthless. And that's exactly what happened. Figured out the cost basis. We took in 189 premium with all the cash secured puts and covered calls. Times that by 5, it was 945. I also started at the 5,800 because that's where we agreed to sell our contract at. So essentially, it's where you sell your contract, the difference of that, and the where you got assigned on your put, and then also take into account the premiums you collected the whole time. So this is a 31.5% return. It was actually slightly more when I did the math, 547.5. So really good position. Made now $950 or so on this trade. It did take a few months, but it's good to be patient on these. And this is why I give lifetime access to these strategies. You don't want to just see it for a month and then get out. Definitely reasonable in looking at how I manage these things. We're going to be doing a new covered strangle on Monday. So if you're interested, you can click the link in the description down below for the safeguard trade or consistent passive profits. You'll get lifetime access to this trade and other futures-based trades. Haven't had a loss on this strategy in over 2 years. A lot of the times we sell the naked puts, let them expire worthless, or take them at a good profit, typically 75% profit. If we get a sign, we're okay. Being patient, selling premium, looking at the long-term mindset, SPY and the futures equivalents, MES and ES, have that long-term economic growth of the U.S. economy. They're eventually going to come back. So if you have any questions, let me know in the comments down below. Thanks for everyone watching. Like, subscribe, all that good stuff. Helps out the channel. I'll see you guys on the next one.